Welcome to the debate from MacroSpire.com. Before we begin, this content is for informational and educational purposes only. It is not financial advice and should not be relied upon for investment decisions. Past performance does not guarantee future results. Always consult a qualified financial advisor. Today, the Hawk and the Contrarian go head-to-head on Michigan sentiment at 55.5. Consumers see what markets don't. Let's get into it.
Michigan sentiment just hit 55.5, that's 15% below the pre-pandemic average and the lowest reading of the year. Consumers across every income bracket, every age group, every political affiliation are telling us the same thing: they see trouble ahead.
And they've been seeing trouble ahead for 4 straight years while the economy kept growing. Sentiment hit 50 in June 2022, worse than the financial crisis, and GDP grew 2.9% that year. This index measures vibes, not reality.
That's the laziest dismissal in macro. Yes, sentiment was depressed in 2022, but the composition matters. This time, personal finance expectations dropped 7.5% in a single month. That's not vibes, that's people looking at their bank accounts.
People looking at their bank accounts while unemployment sits near historic lows and wages are still growing above inflation. The current conditions component is actually holding up much better than the expectations side.
Right, and that's exactly the pattern you see before downturns: current conditions lag while expectations lead. People still have jobs today, but they're telling you they expect things to get worse. That gap between current conditions and expectations is flashing red.
It's been flashing red since 2022. At what point do we admit the signal is broken?
The signal wasn't broken, it was early. The lag between sentiment collapse and actual spending pullback has been longer this cycle because of excess savings from the pandemic. Those savings are gone now.
Fair point on savings, but you're cherry-picking. Sentiment predicted 10 of the last 3 recessions. The track record is genuinely terrible as a timing mechanism.
I'm not using it as a timing mechanism. I'm using it as a direction indicator. And the direction is uniformly negative. That's what's different about this reading. It's not partisan, it's not one cohort. Everyone got more pessimistic simultaneously.
Sure, but what are they pessimistic about? Inflation expectations stalled at 3.4%. That's not great, but it's not spiraling either. 6 months ago people expected much worse and it didn't materialize.
You just made my point for me. We had 6 consecutive months of declining inflation expectations, and that trend just broke. The stall at 3.4% is the story. It means consumers no longer believe disinflation is continuing.
Consumers also believed inflation would be 5% back in 2022, and it came in well below that. Survey-based inflation expectations are notoriously unreliable compared to market-based measures like break-evens.
Except the bond market is actually confirming the consumer read this time. Look at the yield curve, it's telling you the same story consumers are telling you. The bond market already knows.
The yield curve has been sending mixed signals for 2 years. If you traded every inversion scare since 2023, you'd be broke.
And if you'd ignored every leading indicator since 2023 because it was inconvenient, you'd be exactly where consensus is right now: unprepared.
I'm not ignoring indicators, I'm weighting them properly. Hard data, payrolls, retail sales, industrial production, all say the economy is growing. You're asking me to override that with a survey.
Hard data is backward-looking by definition. Payrolls tell you what happened last month. Consumers are telling you what they're going to do next month. And when people say their personal finances are deteriorating at this rate, spending follows.
Spending follows eventually, maybe. But the lag is so variable it's almost useless for positioning. You could be right directionally and still lose money for 2 quarters waiting for the turn.
That's a risk management argument, not an economic one. I'd rather be early to defensive positioning than late. The cost of being wrong about caution is low. The cost of being wrong about complacency is enormous.
I actually agree with you on risk management. But defensive positioning doesn't mean panic. It means recognizing that 55.5 is below average, but it's not crisis territory. We were at 50 and 52 in prior readings, and the sky didn't fall.
The sky didn't fall because fiscal stimulus was massive and savings buffers were thick. Neither of those conditions exists today.
No, but the labor market is tighter than it was in either of those periods. That's the buffer now. As long as people have jobs, sentiment stays soft but spending stays resilient.
And what happens when sentiment finally feeds back into hiring decisions? CEOs read the same surveys. When consumers get pessimistic, businesses get cautious on headcount. That's the reflexivity you're ignoring.
CEOs look at their order books, not the Michigan survey. But look, I'll grant you this, the breadth of the decline is notable. When every demographic moves together, that usually means something real is happening, not just noise.
Thank you. And I'll grant you that the level alone isn't catastrophic. It's the rate of change and the breadth that should concern people.
So we actually agree more than we disagree. The question is whether you position for the worst case or the base case.
When every consumer cohort is simultaneously downgrading their outlook and inflation expectations stop falling, you position for the worst case. The market will catch up to what consumers already see.
And when hard data still says expansion and sentiment has cried wolf for 4 years running, you stay invested but hedge your tails. The pessimists have been wrong at every turn, until they're not, the burden of proof is on them. The hawk, the contrarian, thank you both. What do you think? Let us know in the comments. Read both articles in full at MacroSpire.com. Thanks for listening to the debate.